In this first video, I'm going to demonstrate the direct method to prepare a statement of cash flows. In the accompanying video, you will find the indirect method. The direct method reports directly in the statement of cash flows the cash effect of the operating activity. So it's important to point out that items that have no cash effect, like depreciation, simply are not reported. To begin, print out the financial statements for Bannock Corporation found on the first tab of the attached Excel workbook as shown on the screen. Once you've printed, move on to the second tab where you will find the pre-built template for us to use. Let's begin by taking a look at the template. You're going to see off to the right here is a blank statement of cash flow. So our goal is to fill this in using the direct method by the end of the video. What we have off to the left are different ways that we're going to analyze our statement information to try and figure out exactly what was the cash portion of the transaction. So let's begin by looking at operating activities in the terms of cash inflows for Bannock Corporation. First of all, we'd like to determine what was the cash inflow from customers. So looking at your handout, we've got our income statement and our balance sheet. And what we have to recognize is that cash inflows from customers are likely going to come from sales. However, not all of the sales are collected immediately in cash. So I'm going to move over to the right-hand side and I'm going to recreate the entries so that we can figure out what was the cash portion. So when it comes to sales on our income statement, we see we had $678,000 in sales revenue. So I'm going to go ahead in my T account, I'm going to drop in my $678,000 credit to sales, acknowledging that at the same time, if most of our sales were on credit, we would also have a debit to accounts receivable. Okay, so now I have included not only an income statement account, but now I've pulled in a balance sheet account. So it's important that I recreate that entire balance sheet account. So I'm going to go to my balance sheet and I'm going to see what was the beginning balance of my accounts receivable account. So the beginning balance I can see in 2016 was $51,000. So I'm going to go ahead and fill that in. Looking at my balance sheet, I also know what my ending balance was in 2017 for accounts receivable. It was $65,000. So if I know what my ending balance is, I can go ahead and I can solve for the cash amount that my customers actually sent in to me. So I'm just going to do a quick calculation here on the side. Take my $729,000 minus my ending balance that I know I have. $664,000, okay, is the amount that I have actually collected from those sales revenues that I have booked. So I'm going to go ahead and off in the middle, I'm actually going to rebuild the journal entries just to further drive the point home of the entries that must have taken place for us to be able to determine what that cash exchange was. So as you can see, the entries that we had on the far right have been now translated to some rebuilt journal entries. We'll deal with the cost of goods sold here in just a minute. But what's important is that the cash received from the customers, $664,000, that is what we want to go ahead and move over to our statement of cash flows. So it's going to come over as a debit. And we've begun the statement of cash flows. All right, moving on to payments to inventory suppliers. Now we're going to take a look at that cost of goods sold and inventory entry that would have accompanied our credit to sales revenue if we were under the perpetual inventory system. So looking at our income statement, we see that our cost of goods sold was $411,000. So that will translate as a debit to cost of goods sold and a credit to inventory. What I'm interested in here is this credit to inventory. So as I go down to the two balance sheet accounts that I'm going to analyze to be able to figure out my cash outflow to suppliers, merchandise inventory and accounts payable are the two accounts that I will need, and you'll see that I filled in the beginning balances from my balance sheet. So what I want to reflect is this credit to inventory of $411,000. So again, going back to my balance sheet, I knew my beginning balance of merchandise inventory is $86,500, but my balance sheet is also telling me what my ending balance for merchandise inventory was, which is $63,800. So I know that my balance here needs to be $63,800. So since I'm running a negative balance here, if I want a positive $63,800, I'm going to have to add that to this negative balance. So I'm just going to calculate that off to the side. $388,300 is what I then must have purchased during the time period that we're looking at here. There we go. So I'll delete that calculation. I've got an ending balance of $63,800. If I purchased merchandise, then I must have also increased my accounts payable. So if I had a debit to merchandise inventory, I should have also had a credit to accounts payable for the same amount. And we'll rebuild those entries here in just a second. Again, going to my balance sheet, accounts payable, I need to see what that how I ended the year in accounts payable. Okay, so accounts payable, I had a beginning of the year balance of $30,000. I purchased inventory for $388,300. And I know that I ended the year with a balance of $25,000. So again, I'm just going to calculate off to the side here what my T account is coming up with now minus what I know that I should end the year with. $393,300 is the amount that I've actually paid then to my vendors throughout the year, right? Which is what we're looking for. We're looking for the amount of cash that went out the door to my suppliers. Okay, so let's build those entries off here in the middle before we pull that $393,300 to the statement of cash flows. So here we go. We've got our debit to inventory of $388,300 with a credit to accounts payable. Okay, then we also have a debit to accounts payable as we pay our suppliers. And I'm going to take that $393,300 and move it over here as the amount of cash that was actually paid out to our suppliers. Up next, we're looking for cash outflows for operating expenses. So the first thing I'm going to do is take a look at my income statement to see, well, what did we have on our income statement for other operating expenses? And we see that we had $67,000. So I'm just going to go ahead, and when I'm rebuilding my entries, I'm just going to go ahead and put that $67,000 in here as a debit for operating expenses. But I also want to then visit my balance sheet and see, do I have any balance sheet accounts that maybe would be slowing down that cash transaction? So as I look at my balance sheet accounts, we've already dealt with cash, we've already dealt with accounts receivable and merchandise inventory, but prepaid expenses is a good example of one of those accounts where we might have had a delay in the cash transaction. So I'm going to go ahead and drop in my beginning balance for prepaid expenses. And I'm also going to pay attention right away to that ending balance of $4,400. So if I started with a beginning balance of $5,400 and I had an ending balance of $4,400, that lets me know that we must have had then a cash transaction of $1,000. So or I'm sorry, not a cash transaction, but we had a change in that prepaid expense balance of $1,000 as we expensed. So what I'm going to do is I'm going to pull that prepaid expense $1,000 credit over to my journal entries. As I keep going down the balance sheet, another account is in the liability section. So we already addressed accounts payable, but wages payable is one where we haven't quite taken a look at it yet. So I'm going to drop in my beginning balance for wages payable. My ending balance in this case is $6,000. So to get an ending balance of $6,000, that means that I would have had a credit to wages payable of $9,000. So I'm going to go ahead and enter in, or I'm sorry, a debit to wages payable for $9,000. I'm going to move that debit then over to wages payable. And now we can see that we're trying to solve for the cash paid to the vendor or the employee in this case. So at this point, we have booked operating expenses on our income statement of $67,000, and we had changes in our wages payable account and prepaid expenses, debits and credits. When we look at all of those together, we'll be able to solve for what was the actual cash that was paid out to the vendor or to the employee. So we'll go ahead and make this balance by adding the $67,000 to the $9,000 and subtracting out the $1,000, which gets us $75,000 would indeed balance this transaction. So we're going to pop over to our statement of cash flows, and we'll go ahead and drop in the $75,000 for operating expenses. So to try and summarize that up for you a little bit, you know, on our income statement, we reported operating expenses of $67,000, but we had to go to our balance sheet to see if there was any other activity that would have either increased or decreased our cash off of that $67,000. So when we looked at our prepaid expenses, we saw our prepaid expenses went down, but these are expenses that we previously outlaid cash on, right? So we would actually go ahead and decrease our operating expenses because this is cash that actually left in a prior period. Whereas wages payable, we saw a liability account go down, which is, hey, we incurred the expense in a prior period, but we hadn't paid the cash out yet. So in this case, we had to add the $9,000 to the $67,000 or $66,000 after we went ahead and dealt with the prepaid expense change. So I hope that explains why we came to the $75,000. Because again, remember, we're just trying to determine what was the cash change during the period. And because of accrual accounting, simply looking at the income statement and the expense, that's not going to tell us what was the actual cash change. All right, let's finish off the operating activity section of the statement of cash flows by lastly looking at income taxes. So taking a peek at your income statement, you can see that you had income tax expense of $43,800. So I'm going to go ahead and debit income tax expense and credit income tax payable for $43,000. I'm sorry, it looks like it was $43,890. All right, so we've got our income tax expense. I'll fill in our debit and credit on the rebuilt journal entries. What we want to solve for is income tax payable and the cash paid for income taxes. Again, we'll go to the balance sheet. We know that we want an ending balance in our income tax payable account at $3,400. So I'll go ahead and pop in $44,290, which will get our ending balance to $3,400. You can see I finished our our journal entry right here. So we now have come to the cash paid for income taxes. I filled it in up here in our statement of cash flows. Next, we'll move on to the indirect method.